We're going to combine chapter 13 and 14 because we don't cover all of them. We're just going to cover one section on chapter 13 just to kind of cover the very basics of personal income tax, because I do think that's important for all individuals to understand just the basics, not that I expect you to be tax preparers. And then we're going to cover chapter 14 on three of the types of depreciation calculations. So, section three, our personal income tax. There's going to be a few different things that we'll do. So, one is going to be find our adjusted gross income. So basically, what that's asking you is how do you know everything that gets taxed on your 1040. So if you would get W-2s from your employer, that's all your earned income. You're going to add those in there. If you have 1099 income, and you might think, okay, well, what is 1099 income? It'll show if you've earned any interest from banks, if you got paid any dividends from investments, if you had stocks and you sold those stocks and had capital gains, or again, you could have capital losses as well if you sold them for less. If you were self employed, so say you did some door dashing on the side, you're going to get 1099 income. So all of those kind of things still get added into our earned income to calculate that adjusted gross income. And then if we're ever have unemployment, that too will come on a 1099 from the state, and that is taxable to us and included in our adjusted gross income. So you kind of add in all of those incomes, all those earned, and then there are some deductions that you can take from that adjusted gross income. Those change from year to year. So just kind of read the problem to see what it tells us, because again, some of those are different now than what even we have in the textbook. Then so we can subtract out what is taxable to us. So we can subtract out IRA, retirement type contributions. We get to subtract out a standard deduction. And then in the textbook, we're subtracting out personal exemptions. Again, the textbook is a little dated in their taxes. They go back to, I think, 2017. But it's just a good example. Again, tax laws change every year, so always kind of make sure you understand that. But in 2017, these were the rules. So our standard deduction goes to, are we single? Are we head of the household? Are we married filing jointly or married filing separately? The personal exemptions, like we would have one for every person living in our household. Then once we subtract those out, that leaves us our taxable income. And, a lot of times if you really are taking a payroll class, we would go to tax tables that would go line by line based on what your income level is. This is going to have us use more of a formula approach of our taxes. It's still a table, but it's not quite the detail. So you'll have, if you go to a single table, a head of the household table, married filing jointly table, look at the income and it'll give you a tax, plus you'll pay a percent over certain limits. So again, just kind of follow that formula that's given to us in the table, and then that'll tell us how much tax we owe, and then we compare that to what was withheld from our paychecks, and we'll either have to owe the IRS or we'll get a refund. So again, it's kind of the basics of taxes, but again, going back to 2017. Then in chapter 14, we cover our depreciation methods. So you're also going to have this in financial accounting, but I do think it's important for all business majors to understand depreciation. So when we buy a long-term asset, something that's going to last for a period of time, like a car or a trailer or a piece of equipment that we use in our business, whatever we pay to get that asset is our cost. So initially, we don't charge it to expense. I mean, it could be $20,000. We're not going to write that all off against our income. So it goes into what we call an asset. So it goes into something that we value on our books and has future service potential to us. So that's what an asset is. Then we say, well, how long is it expected to last? So that's our useful life. Are we going to use it for 7 years, 10 years, 5 years? How long do we expect it? IRS does give you some guidelines if you're thinking, well, I don't know. And then we look at what is our salvage value. So our salvage value says, well, at the end of its life, if I've bought a truck and I expect it to last 7 years, what's it going to be worth at the end? How much can I sell it for? How much can I trade it in for? That's my salvage or residual value. So then we want to take and figure out the cost minus the salvage value. We want to write that off to expense over its life. So how do we write it off to expense? We depreciate it. So that is what our expense is going to be, depreciation expense. We take that cost and we allocate it out over its life. And then how we account for it is we always leave the cost in our asset. We have this account where we keep a running total of how much we've depreciated. And that running total is called accumulated depreciation. So our cost minus that accumulated depreciation is what the asset is worth to us on any given day. So then we come to these methods of how do we depreciate it. So straight line is the easiest and the most common. It's our cost minus our salvage value. Again, what did we buy it for today minus what we expect to get back at the end of its life. And then we divide that by its useful life. And that's how much we're going to depreciate. It's the exact same amount every year over the years that we have that asset. The declining balance is a little bit harder to compute. We calculate first our straight line rate. So our straight line rate is 1 divided by the useful life. So if it was 1 divided by 4 years, it'd be 0.25. If it's 1 divided by 10 years, it'd be 0.1. So that's our straight line rate. Well, then we're just going to double it. So if it was 0.1 and I'm using the declining balance, I'm going to multiply that by 2, and I'm really going to take 0.2 times that book value. So again, our book value, the very first year would just be our cost times that 0.2, but every year thereafter, we have to take the cost minus what we've already depreciated. So we always have to kind of take into consideration how much depreciation have we already taken, subtract that out, and then multiply it by that rate. The units of production, excuse me, is comparable to the straight line. It's our cost minus our salvage value, but instead of dividing it just by the years we expect the asset to live, we divide it by its units. So let's say it's that truck that I was saying that we purchased. Maybe instead of saying, hey, I think the truck is going to last for 7 years, I say, I think I'm going to drive that truck for 200,000 miles. So then the units of life are the miles. So then you'll calculate what's your value divided by the miles you think you're going to drive it. And that's going to give you a depreciation rate per mile. So then every year I look at, well, how many miles did I drive this year, and multiply it by that depreciation rate. So that one works well for vehicles for sure. Possibly like equipment that has like hours it runs, like if you're running a piece of equipment and it's only going to last for so many hours. But if it's a building or something like that, it's probably going to be better to use straight line. So those are our methods of depreciation. Again, we'll have problems that we do all of those, and it should help you in your you'll learn this also in your financial accounting class.